Welcome to the Lend Academy podcast, episode number 274. This is your host, Peter Renton, founder of Lend Academy and co-founder of Lend It Fintech. Today's episode is sponsored by Lend It Fintech LATAM, the largest fintech event dedicated to lending, payments, and digital banking in Latin America. It's happening online, December 8th and 9th. Despite the pandemic, Latin America still remains the hottest region in the world when it comes to fintech, with so much innovation happening. So join the LATAM fintech community online this year, where you will meet the people who matter, learn from the experts, and get business done. Lend It Fintech. Lending and banking connected. Sign up today at lendit.com/LATAM. Today on the show, I am delighted to be talking again with Jared Kaplan. He is the CEO of OppLoans. Now, OppLoans is focused on the subprime consumer, and they partner with banks, which we get into in some depth in this episode. Jared believes that the future really belongs of the subprime lending space belongs with banks. We talk about why that is. We go into obviously what's happened this year with his customer base, with his company. We also talk about the new True Lender finalized rule from the OCC and what that means. We talk about the changes that he's had to make with underwriting and why it was finally great in some ways to have a recession data, because that's something that obviously many online lenders have never been able to provide before. So we talk about that, and also we talk about the future of the industry and much more. It was a fascinating interview. Hope you enjoy the show. Welcome to the podcast, Jared.
It is great to be back, Peter. Thanks for having us again.
Yes, of course, I should say welcome back. It's been 18 months or thereabouts since you were last on, and I know a lot has changed in that time. But why don't we just kick it off by just giving the listeners a quick description of OppLoans, so we all know what we're talking about here.
Sure. We're a financial technology platform that powers community banks to provide credit access to what we define as the credit-challenged middle-income population. So it's not low-income consumers, it's middle-income consumers, your U.S. median consumer. And the idea behind the business is that half the country lives paycheck to paycheck. You have 60 million Americans that lack access to traditional financial products. And that's not my number, that's the New York Fed's number. They came out with a great study last September. And essentially, if you have less than 620 FICO, you're abandoned to the markets of last resort. So banks are looking a way to provide credit to that population, and through our platform, they're able to do it in a seamless manner that gets the customer the best available product. And if it's one of their products, it's structured in a way that should rebuild credit and then ultimately graduate them back to mainstream financial credit products.
Right. So then maybe can we just dig into that a little bit? The typical customer, I mean, you said they're like this, they all sub 620. Is that primarily who you're talking about here? And just kind of, what sort of income levels they are, that sort of thing.
Sure. So the average customer makes $50,000 a year. They have a job, they have a bank account, and they have a thick credit file. It's not a thin credit file customer. It's someone that did something terrible to their credit based upon traditional credit metrics. And so the whole model is about finding that customer who admittedly did something bad to their credit, but actually has the willingness and the ability to repay and deserves a fairer product to pay for whatever they need to pay for, and then ultimately get back to the world that they used to live in.
Right. So this might have been these people might have been like 740, 750 FICOs at one point, and then they had something happen and they went down to 550, and now they're trying to claw their way back. Is that fair to say?
Yeah, I mean, they could be, they could have been mid 600s, they could have been early 700s. What we find, our customer on average, if you look at FICO data, 550 to 620 customers, kind of the sweet spot. But they all were higher at some point and had access to more traditional financial products before their traditional score fell below that magical 620 line. And that's where we're able to help these banks figure out who the best customers are and get them a product that's more structured in line with their risk profile.
Right. Okay, so then let's talk about this year for that customer base and for your business. What take us through. Obviously, from the beginning of March all the way through to today, and we're recording this on the 2nd of November. So take us through how this customer has what's happened to them this year.
So back in late February, we started looking at the potential impact. And we had this recession playbook that we had put together. I can't tell you how many times we were asked, what happens to the business in a recession? And we had the best answers. The only thing we didn't have was any data. Right. The business was founded after the last recession. So no one believed us. So we were like, okay, now is the time to prove the resiliency of this customer. It is played out counterintuitively. The customer in some respects has never been healthier. From a credit and a cash perspective, one of the key alternative data points that the banks have adopted as part of their underwriting models is how much money they have in the bank account. And when stimulus hit in mid-April, these customers had 5 or 6 times the amount of cash that you would expect to see in their bank account in a normal market environment. And so the addition of stimulus, the fact that they were not spending money on discretionary items like vacations, the fact that the number one driver of the product is someone trying to fix their car that broke so they can get to work. Our customer was healthy and they repaid debt at rates that we had not seen in the company's history. And demand fell as a result. So what you had is a consumer base that was not borrowing because they didn't need the money. And for this product, which is a high cost product, it's a great thing, right? Customers shouldn't be willy-nilly taking loans if they don't have an emergency unexpected expense they have to fulfill. Now, so just pausing from the second quarter on, very, very healthy customer, and that was great to see. We did see about 10% of our base skip a payment. We took a very, very generous approach in tandem with the bank partners when someone had any difficulty paying. And out of that population, 99% plus have become current. So that's been quite a successful story, and I think has built a tremendous amount of loyalty with the customer base. But now we're at a really inflection point. At 7 to 8 months past the onset of the crisis, we have seen those same bank accounts dip to below where you would expect them to be at this time period, and that's a phenomenon here in the last couple of weeks. And I think a direct result of a lack of additional stimulus, the fact that there is a portion of the population that's making less money than they did last year, and you're seeing delinquencies return back to what we would consider normal. So that is a trend. We'll see what happens with stimulus. I think we all believe stimulus is going to happen. We can argue whether it's right after the election or early next year, but it will happen at some point, and that probably is enough, hopefully, to get the customer to the other side of this thing when a vaccine is more prevalent and spending patterns return more to normal. So we'll see how it all plays out, but certainly not as we had thought early on, but thankfully for the customer, they've been able to navigate pretty well.
Right. So does that mean that the loan demand has picked up? I imagine it's picked up from second quarter levels, but has it picked up to pre-pandemic levels yet?
It's picked up considerably. I will tell you, a large part of our acquisition is driven through search engine optimization, through Google and other search engine traffic. And so we track the major keywords that drive that traffic. And I would say we're still only about 60%, 60, of what you would expect at this time of year. So it's still actually quite muted. It looks like a traditional tax refund season still.
Huh.
And it's not surprising, right? Because people are still huddled up. If anything, we're gone, backwards a little bit here the last couple of weeks, certainly in some regions. So it's still quite dampened from the peak, which I would consider to be early March of this year.
Right. Even though like stimulus is really, the unemployment stuff ended at the end of July. The stimulus checks went out, April timeframes. So it's been months. So you're still seeing like a typical tax refund season. That's really interesting.
It's just the consumer is not spending as much, nor do they have. So I think some of the same drivers as before are still relevant. People aren't going on vacation, right? people don't typically use these products to go on vacation, but vacation drains the bank account.
Right.
So when something unexpected pops up, you don't have the cash. So they have a little bit of extra cash because of that. And then we talked about car repair being a big driver, so people are certainly driving less still. And then the other major driver we see is payment for healthcare deductibles for consumer-driven health plans, and people are less comfortable going to the doctor still, so there's still less of that activity going. So I think it's a combination of factors, but it certainly is a moment in time. I would describe the demand in the space to be almost insatiable as late as early March of this year in this space. And so, we do think on the other side of this, it probably returns, and maybe even returns with greater impact, because we still have seen a number of the lending platforms above us stay relatively tight.
Right.
And that's a very, it's not as tight as it was in the second quarter, but it certainly hasn't returned to normal. There's certainly a larger percent of those customers that don't have access the way they used to.
Right. And so that's, you've had this, we talked about this last time, but you call it your turn up program rather than turning down. You refer people on to the lower cost, the lower cost platforms. But are you finding that's happening less now because, as you mentioned, a lot of them are much tighter than they were before? So are you still doing that program, and is it as successful as what it was before as far as conversions?
So the turn up program, just to describe that, at the beginning of the application process, as a customer is applying, they're given the option of whether they'd like us to do a diligent search on their behalf for sub 36% APR products. And so we go out to about 15 near prime lenders and see if anyone has an appetite to the 96% of customers that opt into that process. And prior to COVID, we saw about a 7% offer rate. So 93% of the time there were no offers. 7% of the time a customer received at least one offer. And through this period, we actually saw the match rates dip a little bit. We were less successful at being able to find them other products out there. And that's come back to about 7% again. So we're a little bit lower than we were. That's why I say it's still a little bit tighter. But yeah, it definitely showed up in the April, May, June time period, and it's come back a little bit, but not all the way.
Right. So I want to talk about the industry as a whole. We've seen commentary from some of the federal regulators that they want to see more banks get involved in the small dollar loan space. Obviously, we've had US Bank I've had it for many years now. Their small dollar program. Just saw recently Bank of America are getting into it, and Varo announced they were going to be doing a very small dollar program. We got Square. I mean, what do you make of sort of this increased kind of awareness of this product?
So it's obviously a large percentage of the population that struggles to get access, right? So the regulators, for the longest time, have been trying to get more and more banks involved. For a number of reasons, banks are best positioned to offer a product to this customer space. They can do it at the lowest price points. They have the lowest cost of capital. The cross-sell is essentially free to them if they already have the customer. They have deposits, which puts them first in line to get repayment. They have transaction data, which help underwriting. And you're thankfully seeing more banks get into the space now, along with some of the financial technology companies that have bank-like products, like Cash App, for instance. And that's a terrific trend. We've been surprised it's taken this long. US Bank's Simple Loan product launched in mid-2018, and it was up until now that you really hadn't seen many new entrants. But there clearly is a need, and the more players you see in the space, the more ferocious the competition is. And so consumers should have more choice. And the banks are offering are highly regulated, so they should have the consumer protection. And our thesis all along has been that banks should be the one leading access in this space, and the big guys should be able to do it themselves. The community banks and the credit unions probably can't do it themselves and should be partnering with financial technology companies like OppLoans to provide the product. And we are big believers that you can have access with appropriate consumer protection to create the best pathway for the consumers. And we're finally seeing that happen. And I think there can be a lot more to come on that note.
Right. Yeah. So on that, I mean, you talked about when you described your company, you described a little bit differently, I think, than what in the past. And you have this powered by OppLoans offering. I was on your website last week, and you have three banks that are on there now. I mean, it sounds like from the way you're talking, this is what you see as the offering is. You want to power all of these smaller banks to give them a subprime offering.
Yeah, from our point of view, there's 10,000 or so banks in the country, give or take, and more and more market share has shifted to the top 10 guys over time.
Right.
And the credit unions and the community banks have really been left out. And financial technology is a great way to even the playing field for them. And so we've loved the model. We've got three tremendous banks that we have partnered with that have outsourced essentially their small dollar platforms to us to power with our servicing and our technology. And that gives them a really interesting product to compete in the marketplace. And we just feel like it's the right answer for the space. This space has a long history, right? And has evolved quite a bit over the last couple of years. And there's always this debate. And when I spend time in Washington talking to members of Congress, right, it's this debate over access at what price, what does the right guardrails look like? And so we have taken the approach that banks provide the best medium for the reasons that we talked about earlier. Mm-hmm. And we want to be the leading player in powering them into the marketplace.
Right. Okay. So do you expect then that you're going to see dozens of these banks, in the near future that will be powered by OppLoans? I mean, is this a core part of your strategy going forward?
Yeah, I'm not sure if we'll have dozens of banks. I think that these banks, each one is a tremendous administrative burden on the platform to make it work. And that's a great thing, right? I mean, banks are difficult. They have, and they need to be given the regulatory compliance and oversight that is demanded of them. And so that is by nature passed on to us. And we're lucky to have the partners we have, please. I mean, that is for sure. But it is a ton of work and creates numerous hurdles for us to go through to be able to get to market. So, I'm not sure how many more we'll add, but I think the space you'll see a lot more activity, right, and a lot more innovation, and so that is ultimately a great thing for more credit access.
Mm-hmm, mm-hmm. Sure. Okay, so I want to go back and talk about this year again, and as far as the changes. Obviously, you talked about how you'd never been through a recession, and now you've got that kind of the history of what has happened this year in your playbook. But how did you approach underwriting this year? Did you make any adjustments? Were you using different data sources? What were the adjustments that you've made?
So the recommendations we make to the bank partners as far as their underwriting models are concerned are always based on alternative data, right? With heavy emphasis on bank data, on verifying income, on verifying consistency of income. And that all played out quite strongly through this period of time. So, I would not say that there were material changes that were made by the bank partners as we headed into COVID, even with some of the uncertainty. And the thesis played out pretty well. A lot of the customer base, just given some of the underwriting attributes, is concentrated in Amazon, in the post office, in drugstores, municipalities, parts of the economy that have proven to be quite resilient through this. And so I think that was helpful as far as the banks and their books of performance through this process. And it's one of the advantages that the alternative data has compared to the traditional data that many still rely on, right? And you're going to see that heightened even more coming out, there's been some press on what the credit score means now, given so many customers have been flush with cash and have paid down debt and improved their scores. Is, yesterday's 680 still the same today? And what does all that mean? And that will be very, very interesting to play out on the other side of this. Mm-hmm. Whereas the underwriting models that the banks use, are still finely tuned to the same key points, which is, making sure someone's got the ability to repay, and that's heavily driven by you make what you said you make, and the consistency of income is such that you should be able to repay the loan in a reasonable period of time.
Right, that's interesting, because I know I noticed that this consistency of income. You said this at Lendit a few weeks ago. You were talking about how it's really important not just to verify income, but to verify the consistency of income. And how are you doing that? Are you doing that just through bank transaction data? Are there other methods that you can use to verify consistency? Because obviously, it has not been the most consistent year for many people.
Yeah, so it's certainly a combination of data points that all roll into proprietary scoring. But at its core, it's very complex to judge consistency, because that is driven by how many jobs you've got and what the frequency of how you're paid in those jobs. And it can come in many forms and fashions. And so the proprietary technology that we've developed can ingest all those data points in real time and determine whether consistency is at the appropriate level that would allow someone to be able to repay a loan. And I think that's a big part of our success when it comes to understanding who a customer is beyond some of these more traditional metrics that have been used historically.
Right. So you're doing 1099 data. If they might be driving for Uber or Instacart or something, and then they've got a W-2 job as well. They might have a little consulting gig as well. I mean, you're able to kind of gather all that stuff in.
That's right. Gather it all in. Look at the history. Look at the recency, and have it all boil down to was ultimately a proprietary score on whether it makes sense or not.
Right. Okay. So I want to talk about TrueLender, because we had some movement. I think it was just last week. The OCC issued their final rule on TrueLender, and it was pretty much what they said earlier in the summer. How the new acting head of the OCC, Brian Brooks, was pretty adamant about this, and it's a pretty simple rule. I mean, it's like 2 sentences. And yep. So wanted to get your take on the impact on the space in general and on your business.
I think even backing up beyond the installment loan space, the TrueLender thing is fascinating, right? If you look at the way that many credit card companies and mortgage companies work in tandem with banks, these partnerships are not novel. Right. I think they're newer in the installment world, but I mean, the shape and form of a bank partnering with another company to provide an asset in consumer finance is not new. Clearly, lots of noise in the installment space for a long period of time, and it's great to see the OCC come out with a bright line test, and I think it's a big step forward for the industry. And we know, just in the way that we work with banks, what those relationships look like, and the amount of control that they have over the programs, and what we think are kind of model structures. And again, we just think it's another data point on the road to more mainstream credibility for these products, which ultimately will create better opportunities for the consumer. And so hopefully this will give lots more banks confidence to enter the space in some form or fashion. Right.
But I do want to address there's obviously opposition to this ruling, and there may end up being lawsuits. We don't know, but sure. And there's obviously, there's been several people that I've seen in public settings that have been highly critical of the space, highly critical of your company, saying things that I thought were just horrible. But I wanted you to give you a chance to address those. I mean, I know you've seen these criticisms that it must rankle you to some extent, because I feel like you're doing what you're doing is good work, and these people just don't appreciate it, and they think what you're doing is actually the opposite and is really bad for everybody. And sometimes I think these people have they have wishful thinking where or magical thinking where there should be we've had AOC in Congress say there should be a 15% limit. No one should be charged interest above 15% ever. And obviously there's the 36% limit. And there's people that really believe that your product should not exist. And how do you respond to those people?
We respond with data. We have a credit access crisis in the country, right? And so I have had lots of interesting conversations across the board, and it's true. A lot of the opposition takes the point of view that 36% is the line in the sand that you can't cross, right? It's a very matter of fact point of view, and so we love bringing the data from the Turnup program to that conversation. Say, hey, we're trying to give the business away, trying to give it away, and actually we had a big conversation before we launched Turnups, and we said, well, what if we're successful here and giving the business away and no one needs the product anymore? And we were like, that would be amazing. We're fooling ourselves. I don't want to go to work every day at a company that is taking someone in a really difficult situation. And because we can be fast, they're taking the product. That's not a business I want to be in. So I think we have proven very clearly that there's tremendous demand out there. There's tremendous demand out there because access doesn't exist for the sub 620 population at sub 36% APR. It just doesn't exist. And that does not mean that there should be more legislation or regulation as it relates to consumer protection. I actually think we can do a lot more there as it relates to guardrails to ensuring that we have both access and consumer protection. And there's been, lots of potential law and proposed law that have been pushed back that at OppLoans we are big supporters of, right? The CFPB payment rule being one of them.
Yep.
And I think actually the space doesn't do itself any favors when it pushes back on what is, common sense legislation or regulation to make sure there is appropriate balance there. But listen, if your point of view is you shouldn't get credit if it's higher than 36% APR, or hey, the customer will just figure it out. We just fundamentally believe both of those are wrong. And what we believe is that from an access standpoint, it's crucial that consumers have access, crucial. It's crucial they have access with the appropriate protection, and it can't be perpetual. And this is where the big test in the space will come over the next 12 to 18 months, is which firms can prove that they really can help consumers rebuild credit and get back to these more mainstream financial credit products. And that's what we're focused on, right? It's access with best available products up front. If that is another product, fantastic. If it's one of the bank products, great. Let's structure it in a way that rebuilds credit, and then let's get them something that looks more like traditional mainstream credit within a reasonable period of time. And I don't see how you argue with that.
Right. So, and obviously you said you go to them with data. I mean, what data do you have? Because I think it's a really good point. I mean, if we as an industry are not making the consumers' lives better and making them, really more financially stable, then we've failed, right? But yep. I'd love to get some data that you could share about how that's actually working, like your customer base. I mean, how are they doing better?
Right. So that will ultimately be driven by two potential outcomes, right? Can you quantifiably prove that their credit scores improve over time with these products? Mm-hmm. And or you're able to get them to what we would define as sub 36% APR credit, right, over a reasonable period of time. There are lots of data points that go into the first question, right? The loans that are offered on our platform are typically $1,500, right? And there are lots of other things customers can do with their behavior that will ultimately affect those traditional scores. And so we're working really hard with the bureaus to be able to tease out all of the potential impacts there and come up with something that is incredibly quantitative that we can publicly report on to say, hey, customers that look like X, Y, and Z in this product, here's what happens to their traditional credit scores, and hope to be able to present that in real time. And we want a public dashboard, right? Public dashboard, shout it from the rooftops, here's what happens.
Right.
The other part we're also actively working on, which is we are best positioned. For the longest time, we went around trying to convince near prime lenders to take a chance on these customers once they have taken an installment loan or repaid it, right? And what was frustrating is that a 550 customer that improved to 570 or 590 or 619 still had no options. That the products on the platform were still the best option in town. And so, as we've grown the business and gotten bigger, we've been able to generate more data. And now, in tandem with the bank partners, we're able to get much smarter about pricing on a long-term basis in the current products. So that's, I think, a big improvement. But also, we're working on some real innovative products that will look like traditional mainstream products that these customers will be able to graduate to in a reasonable period of time. And I hope to have some big announcements on that as early as the first half of next year.
Okay, that'll be interesting, because I remember when we last chatted, I asked you about that, about, you don't want to, you should be able to keep these in the OppLoans ecosystem, but we'll look forward to announcements there. But I want to move on and talk about something that I thought was interesting. You just recently announced this last month, partnership with Experian, Steady, and Billshark. Tell us about what you're doing there.
So this is all as it relates to our social impact team, which has done a terrific job, and the idea that financial education has to be a big part of our process and the way that we communicate with customers. And there are some really great, innovative firms up there that can help our consumers, right? And those three partners, I think, are at the top of the list, and they all serve a different part of how we can help customers. But we are constantly looking for ways to expand the brand by bringing better products, by educating customers in how they can take care of their financial health. And so that was our first foray into some official orders after Spring4, actually, which was the first one. Mm-hmm. We launched earlier this year, which is another terrific company that helps customers find alternative methods to income that allows them to repay their loans. So more to come there, but we want to have partnerships with the best companies in the space from a social impact perspective, just to make sure that our folks know what's out there to help them. Right.
No, that makes sense. Okay, so we're almost out of time, but I'd love to sort of close with your thoughts on the future of the industry. I feel like this space. I mean, as you say, I would have thought by now you'd have many direct competitors that are doing just what you're doing, but it feels like everyone's still focused slightly in the more near prime space, and it's not like you have no competitors, but this is less competitive, I think you would agree, than the prime space. So maybe just talk about the future and what you would like to see happen to make this space like a lot more mainstream.
So unless everyone's income goes up and the cost of housing and childcare and education go down, you're still going to have a major pain in the country, right? Which is this dearth of savings. I mean, that is just the reality. And there hasn't been much competition historically. I think there's a number of reasons for that. I think it's hard, right? This is a riskier customer base. You can't rely on the traditional ways of doing business to do this profitably. I think there's also been an overhang, right? There's reputational risk. Some people think about headline risk, all of which we feel very strongly about. There's a right way to do this, and our hope is it gets solved through the banks. Mm-hmm. That's our hope. Banks are credible. They are mainstream. They are highly regulated, and either by themselves or in partnership with financial technology companies should be able to provide much broader access, and much broader access means more competition, means lower pricing. And that's what I think you'll see. I think the federal regulators recognize that. I think they are working the banks. You've seen some great innovations. So Bank of America's product is $5 for $500, right? I mean, that is a terrific product that they're able to get that up to scale and offer to their customer base. So that's terrific, but it's not enough to fix your car. right? So there's that aspect of it. The typical car repair costs $2,000, so there's still a gap there, but we're seeing the right signs. And my guess is a couple of years from now, you'll see many more banks in the space. You'll see other financial technology providers powering them. And what I said earlier, I think rings true is companies are going to build their brand based upon customer outcomes here.
Right.
And customer outcomes are ultimately going to be driven by how quickly you can graduate that customer to what everyone can agree is a mainstream financial product. So we hope to lead the charge there. And if there's some more competition on the way, that will make us have to be that much better. But it will also be a great thing for consumers and the space in general. So we're actually big proponents of that, and we hope it happens.
Right. Okay. Well, we'll have to leave it there, Jared. But it's always great chatting with you, and best of luck. Look forward to those announcements next year, and good luck with everything.
Thank you so much, Peter. Always a pleasure.
Okay. See ya. One of the things that struck me the most in that interview with Jared there was he talked about the future really of the subprime space is with banks. And it's really the reason that companies like companies like OppLoans have done so well is because banks have ignored this group. But, now that they really are aligning with banks, they've got the Powered by OppLoans product really focusing on providing banks with the opportunity to serve this population. And, it makes sense to me. Banks have typically not been able to work out how to make money out of this population, how to serve them in a fiscally responsible way while also making a profit. And it looks like what OppLoans is doing really is providing the playbook for banks in how to do that. So it's going to be super interesting to see how this develops going forward. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's episode is sponsored by Lendit Fintech LATAM, the largest fintech event dedicated to lending, payments, and digital banking in Latin America. It's happening online, December 8th and 9th. Despite the pandemic, Latin America still remains the hottest region in the world when it comes to fintech, with so much innovation happening. So join the LATAM fintech community online this year, where you will meet the people who matter, learn from the experts, and get business done. Lendit Fintech, lending and banking connected. Sign up today at lendit.com/LATAM.